Very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. Well, markets are darting away, almost 320 points gain coming in on the Nifty, 1.5% higher, comfortably above the 22,300 mark. The small cap, mid cap, and the bank Nifty will also come up on your screen. Look at that 1,000-point gain on the bank Nifty thanks to the GDP data. Well, it was a bumper data on the GDP front. Certain sections of the market were questioning the massive difference between the GVA and the GDP data. But now our sources have confirmed from the finance ministry that this is on account of the lower fertilizer subsidy. It's a strong data which is powering the street, and this is the first point which I'll start my discussion with Vinay Jaising, who's also joining us from JM Financials. Vinay, afternoon. Thank you so much for your time. Well, the markets seem to have got mighty enthused by the big GDP number. Now the word on the street is that, two back-to-back strong readings on the GDP. In the last commentary, RBI governor already took their own estimate for GDP higher, above 7%. Broad other agencies, the rating agency and many others could follow soon. Do you think that this is a possibility going forward? Because market was starting questioning it, that is the growth sustainable? Market will start looking valuations if the growth is not sustainable, but growth appears to be falling in place now.
So absolutely, Ajay, thanks for this invite and this question. It's very important to understand that India's GDP growth is on the positive territory, whether, the number 8 plus because of a subsidy reduction will go to the GVA number of 6.5 inching up to 7 plus. For the next year, I think that's a more steady state. Now look at 7+% of real GDP growth for the country, and inching up as times come, as capex really plays out, and as corporate India's earnings increase, and finally when the consumption cycle also comes up, and all that I think will take 6 to 9 months, and you'll see a better growth trajectory for India. But Ajay, let's change the question the other way around. If we were to look at US data for GDP, the US growth in GDP last year has been about $1.6 trillion. What's interesting is the debt increase in US GDP has been almost $2.6 to $2.8 trillion. So US is paying its way out for increasing its GDP by increasing its debt burden even more. India is not doing that. And that's where I think the big difference investors would look at is the quality of the growth of Indian economy is not coming at the cost of its debt going up, but it's coming at the cost of its improving economy, coming, bottom-up basis. And I think that's a big thumbs up for India.
Vinay, which end of your portfolio actually saw the strongest earnings, this quarter? Just want to understand. And overall, how did your portfolio companies fare on revenue front and profitability front?
Sure. I think this was the first quarter. I don't think just our portfolio, but if you look at even the broader, the 500 index, you've seen the financials grow at 20-21%. Overall growth in 25% means the other industries did a lot more better than the financial sector, which I think is a big positive because you need other legs to grow. For us, it was capex and industrials put together, which had north of a 50-55% growth. Railways, again, fantastic growth. So that space, I think in terms of earnings trajectory, did really well. Put the other way around, obviously energy, but we are underweight out there, did extremely well, courtesy the OMC is part of the story. I don't know how long that will sustain or whether we'll start seeing either crude prices move up or margins move down. But I think overall, in terms of numbers, a 20+% year-on-year number driven by our focus on capex made our overall portfolio earnings go up north of 25%, and that was exciting for us. What was a tad bit disappointing, even the auto ancillaries and auto companies, that's the other face in our sector, with companies like Tata Motor doing really well on the earnings front, ditto for telecom. So we had lots of pluses, ditto for pharmaceutical, pharmaceutical and specialty chemicals. Certain spaces were up 25% plus. The disappointments were, in our eyes, largely in the IT space, which was well expected. The financial space, which was also, I think, partly well expected. But apart from that, maybe the consumer space, and that's why I think you're alluding to the question of revenue growth. The consumer space disappointed us a little bit on the revenue growth. as against the sales realization growth, which was better. The volumes are still a question mark as far as we see the consumer space coming, but there was some amount of margin improvement out there. But net, I think post the quarterly result, we've all raised our numbers tepidly, maybe 1 to 1.5% for India Inc. For the next year. So we're now at closer to 15%, moving up to 16% growth for the next 12 months, and that was inching up as we look towards the next 2 to 3 years.
Vinay, I was just speaking with the Auto Components Manufacturer Association's head just about 45 minutes back in my show. There are reports coming in that $6 to $7 billion worth of fresh capex may be lined up by auto component manufacturers. When I asked him what was triggering it, because it's not that the OEMs are, showing very big numbers, but they say that both legacy OEMs as well as EV companies are lining up launches going forward. Plus, emissions are changing the entire demand structure. Emissions, safety, higher electronics and exports. These are a few things it said. Any companies you are playing in your portfolios on auto component side, if you can just tell about the business models.
Sure. So today, as we look at the next 12 to 24 months, yes, there is capex going in both in the EV part of the story, more than IC part of the story. And I think on a year-on-year basis, we are moving to better specifications or lower emission norms for the auto industry. So you will start seeing that phased amount of capex being spent by all the OEMs. At this juncture, we're looking exactly opposite of what you just said. We prefer the OEM place purely because we are seeing good volume demand come up. Names we like, case in point, are companies like Tata Motors. Even today, we are seeing them have a good order book, but more importantly, we are seeing their debt numbers come down substantially, more so globally than domestic. And all of a sudden, we'll have a total net debt negative, which means cash plus company and companies like them. Maruti too post its correction for us now. We are looking at interesting avenues for OEMs as much as ancillary companies, which I think there's a lot already built up in their prices. But you're right, capex is, we are seeing some semblance of growth in capex come up in the auto sector, and the entire sector would gain because of capex coming out as far as OEMs are concerned, as well as the ancillary companies are concerned.
Well, look at that, Munjal Auto, Jamna Auto, you speak about auto components, and Sona BLW was very active. Castrol is up 3%. All these auto component companies are showing big moves going forward. I want to come back on the financials front. Some of the NBFCs have gone through corrections, and PSUs, of course, have done well, large private banks and NBFCs. If GDP indeed goes so strong, then the bond yields are also likely to edge lower, right? And this will be the area which will be benefited. How are you playing the lenders?
So this is an interesting question, and a little bit of just top-down view. Think of it this way, right? So far, the overall loan book has grown by retail India consumption. You're seeing that grow at 30 to 32% on a year-on-year basis, and you've seen that for a couple of months grow. You haven't seen corporate India singing so far as growth is concerned, between 6 to 8%. Once, I think post-elections, you see the next leg of loan book growth, which today is at give or take change 20%. You net off the impact of HDFC Limited, it's at 17% on a year-on-year basis. The point here is if the incremental growth is coming in from the corporate sector, the yields for the loan book for the corporate sector is much lower than the yields of the loan book on the retail sector. The quality of book would be better, but the yields are much lower. So technically, what we're seeing in the banking sector, at one end is robust to high loan book growth. At the other end, the deposits are not growing at the same rate as the loan book. So you're seeing the cost inch up for the banks. At the third end, the incremental loan book is coming at lower yields. So for us, I think there is NIM under pressure in the next year or so, though the quality of the book would be better. And that's the story for us in the banking sector. So we are a bit underweight this space. Having said that, as interest rates move down, which they will, sooner than later, next 6 months, I think max, based on our estimates, you would start seeing all the banks which are linked to the repo rate would have to get their loan book, get their deposit rates or the loan book rates at a lower level, So you're going to see the yields come down faster for them than the NBFCs. So I think now's a nice time to look at some of the NBFCs where we are very confident about on the loan book. The NBFCs could be some housing finance companies, or even some MFIs, which, have more so flat fixed yields, but, get the advantage of a lower cost coming in. This will be exact opposite of what we were probably playing it historically, wherein we were betting a lot more on banks.
One last question before we let you go. Vinay, we were just reading the commentary coming in from Gujarat Fluoro. It's a chemical company. Chemicals have gone through a very long phase of consolidation, sideways move, etc. This is a EV based chemical company. Some big moves which lined up ahead. This is also a space you like, chemicals. Which are the stocks which you are exposing your portfolios to? And overall call on chemicals, is the worst over?
So, when you mentioned the question on auto and auto ancillary, and you mentioned EV, I was tempted to talk about chemicals at that time, but, thanks for this opportunity. See, our perspective, Sudarshana analyst very strongly believes you could be a quarter or two away from the bottom of, where the pain coming in from China in terms of costs, or, the inventory levels going down, and how the realization also for a lot of these companies are at a bottom. So we need to bottom fish out here. Look at those names where you think there's a very robust demand coming up, not just from China, from the rest of the world. And I think there are two, three, companies we like out here. One of them really, courtesy what happened due to Israel and supply disruptions, has already seen bean prices move up, and you've seen Arcane, one of our favorite picks, do really well very quickly in the last month. But we have companies like Tatva Chintan, which play the EV story pretty well. It's tough to say whether this quarter or next quarter would be the bottom of it, but this is something, which we have been owning in our portfolio. It's not done well for us, but we think you're close to the bottom out here. And the other name, we like, which is pseudo chemicals and pseudo healthcare, are companies like Blue Jet, where again, it's been impacted due to some constraint of some pharma company in the, in US not taking the product for them. But clearly these are names which are close to the bottom. And as you start seeing China revive, which could be a quarter or two forward, lots of these names would do a lot more better in the future.
We'll let you go on that one. Thanks so much for joining us on the show, Vinay. Vinay Jaising from the PMS department of the AMC of JM Financial. We'll take a short break on that note, come back. A lot of